A FTSE 100 company in the aerospace and defence sector, along with Rolls-Royce, Meggitt and Cobham plc, the UK's largest defence contractor, 18.5 billion revenue and 81,000 employees worldwide. Their share price is currently trading at £5.34 a share as of this morning, and they have a dividend yield of 4.83. BAE Systems plc are a huge player in the FTSE 100. But do they meet the clean watch list? And are they a company that I'm interested in investing within? Hey there guys, how's it going? Chillingworth here, hope you are well. I want to talk to you today about BAE Systems. These guys are a huge player on the FTSE 100. These guys make some big profits, and they've got a huge market cap. And I want to take a deeper look with them, into them with you guys today to see whether or not, one, they make it onto my watch list, and two, to discuss whether or not there would be a company I'd want to invest in. And we'll look at some charts, and we'll look at the raw numbers, and we'll just do some analysis on this company basically. If you watched any of my previous videos before like this, we'll go through the actual raw numbers first of all, and they are quite interesting for such a large player. Now I've gone back to 2009, so I've got pretty much about 10 years worth of financial data here that I have extracted from the annual reports, and I've crunched. And I essentially will look at the income statement, we'll look at the balance sheet, we'll look at the cash flow statement. Now I have a set criteria of what I'm looking for, and it's a pretty high bar. Most companies don't pass it. At the moment, I have got 20 companies out of 86 companies that I've analysed that I am interested in investing in and trading with a long-term bias to it, with a long bias, I should say. And so I've gone through those financial statements with BAE Systems, and I'm going to walk you through my results. Now, first of all, the thing that kind of props up and becomes quite prominent for me is the gross margin that the company are recording. So essentially, we've got huge turnover. I mean, in terms of revenue that's coming in, we're looking at, back in 2009, we had 21.9 billion. A pattern straight away, and this is something that I'm always looking for. I'm looking not just at the numbers, I'm not just looking at the last year's numbers, for example. The reason, and people say to me, well, what relevance does financial data from 2009, 2010 really have on this business? What I'm looking for is consistency. I want to see, one, some consistency, but also I want to see what is the trend, what's the pattern, what patterns are in the numbers that can give me an inkling and an idea as to where this business has been going over the last 10 years and where it might be going forwards. Now, I'm not one to predict, so I'm not one to tell you where I think BAE Systems are going to be in 2 or 3 years' time. All I'm essentially doing is I'm running these numbers to identify if they are a company that, in my opinion, have increased odds to go up in value in terms of their share price over the next 3-5 years. Because if they are, then they're a company I may want to invest in, to buy shares in. Obviously, you get the dividend payments, but also we're looking at the capital gains of the actual share price itself. Or perhaps to spread bet, to trade, to get in on the short term, whatever your system might be. But I'm looking purely for companies that smash a certain criteria, a very tall order, a very high criteria that's expected. And if they do achieve that, if they beat that, then these are companies that I look at in more detail. And if they continue to pass all of the hurdles, all of the tests that I put in front of them, then I essentially will be looking for opportunities to get into that company through my different systems, whether that's investing, buying shares, whether it's spread betting, whether it's trading. So what I'm looking at here shows me a pattern straight off the bat, and that pattern is the drop in revenue that we see here. We've gone from 21.9 billion, and as you can see, not every year, but over that period of time, we've definitely seen a drop in revenue. quite considerably, down to the point where it's now down to 16.8 billion. And you can see here, I mean, it's been that low before, back in 2014, 2015. It jumped back up to 17 and it's gone back down to 16. But it's fallen all the way down from 22 billion, basically, back in 10 years ago, which is not a good sign. Straight away, when revenue is falling and falling to the tune of what is essentially 5 billion, that's not a good sign. Now, cost of sales has gone down with that. And in fact, the cost of doing business, the cost of bringing in that revenue to that company has fallen at a quicker rate. And we can tell that from the gross margin. So the margin is essentially the slice that they have left over. So if you can imagine that the revenue comes in, then we deduct the cost of sales from that, and what's left is the gross profit, right? But what is the percentage of that gross profit against the actual revenue itself? What's the slice of the cake that they're taking? If the revenue is the cake, what slice do they get to keep, basically? And that is essentially the gross margin. And we want to see this number go up, and it pretty much has. So whilst revenue's fallen, gross margin has increased, which means they've reduced their cost of sales at a faster rate than the drop in revenue, which is more encouraging. But I'm still, the drop in revenue is a real concern. It means that they're unable to make as much money out there through their business. And each year over the last 10 years, that amount of money they've been taking, that they've been building, has disappeared. It's waned. We kind of bypass all of this because that's not the companies have different ways of announcing their accounts and crunching their numbers, and it's just not relevant for this section. And we can take a look at operating profit. That's fine, but where I want to go next is then the interest on debt. Now, that is this interest expenses section here. And the interest that they're paying on debt is actually quite high. Now, it's all relative. And what we do is we crunch how the interest on debt against the operating profit. So, for example, looking at 2018, their interest expenses were 381 million. That's interest alone on the debt, on the money that they owe. And that represents nearly 30% of their operating profit. So put it in another way, 30% of this company's operating profit was eaten up by purely the interest they had to pay on their debt. Now, that would generally indicate that they probably got too much debt going on. Now, there are other numbers that we can crunch in the balance sheet that I've not done because I've not needed to do. But if you were to crunch those numbers, and I'll explain why in a moment, if you were to crunch those numbers, you might find that actually the debt levels that this company have are okay, and they're within the boundaries. But it doesn't detract from the fact that a third of their operating profit is being lost just on the debt levels that they're taking because of the interest. So that's not good. That's very high, and it's consistently been that high. I mean, at times it's been as high as 67%, and 40%, 35%, 39%. It's high, and it's been consistently high throughout the last 10 years, and it's too high. And so that again is not a good sign for me, unfortunately, that the amount of debt that they're having to borrow to achieve what they achieve is too high. Now, we've got extraneous and exceptional sales of assets and other incomes that are not to do with the recurring revenue of the business. And so whilst I record that information, I don't count it into the end results. So, for example, if a company 1 year has a really bad year in terms of the recurring everyday revenue of what that business does, but then they sell off a big asset that's worth millions, well, it can transform their accounts to make them look far better than they actually are. And I'm only interested in the recurring revenue of the business, and therefore I will omit any extraneous big sales of assets from the results. I'll extract them because I want to see what the true picture is regarding the recurring revenue of that business. And so we've taken all that out, and obviously we won't go through the tax, because the tax is the tax. Clever companies know how to reduce their tax bills as best they can, but it's a legal requirement. There's not much you can do about what your tax bill actually is. So we go straight down then to the net earnings, and unfortunately net earnings are not very good. Now they're superb in so much that in 2018, for example, the last annual report release recorded or announced a £735 million profit. You can't balk at 735 million, right? However, what I'm interested in is the fact that this company bring in a revenue of 16.8 billion in 2018, yet the cost of running that business means that they only get to keep 735 million for themselves. Now that's taking out the extraneous sales and the big one-off sales of assets, of intangible assets or physical assets, buildings, property, that sort of stuff, machinery, even arms of their business, different sections of their business that they might sell off. We've taken all that out, and what they're left with is £735 million profit off the recurring revenue of their business. Now, that's not good enough. It's good. It's 735 million. It's good money, right? However, on the grand scheme of the revenue they bring in, it means they don't really keep much of their money. In fact, that works out at 4.4% of the revenue that comes in they get to keep. And you can see here in some years they've been making some losses. They made a loss in 2009. They made a loss in 2013. Other years they've only had about a 3% to a 4% net earnings, and we're looking at 4.4% last year. The bottom line is, for me, that's not good enough. It's too thin. So you can see here it wouldn't really take much for that 735 million to get eaten up somewhere else. All it would take is one big expense or a big loss somewhere in the business, and these guys would not be making any profit. And what we generally see there, as well as the lack of consistency in their net earnings, because it's been up and down, it's been all over the place over the last 10 years, what we generally see there is that the share price gets damaged accordingly. And we're not really seeing any growth from BAE Systems. Revenue is down by 5 million over the last 10 years. Not a good sign. Net earnings has been stuck at around 3 to 4% a year, including a couple of years where they made no profit. In fact, they made a loss. The 63 million loss in 2013. They made a 713 million loss in 2009. It's not convincing and it's not strong. And it's for that reason that this company have not made it through the clean watchlist criteria. They have not crossed enough of the hurdles. The gross margin is too low. The interest on debt far too high, and the net earnings as a result of those costs is too low. And only at 4% is not high enough. I want to see a company with a much larger buffer, as in they could be making far less money. In fact, there are companies in the clean watch list that are from the FTSE small cap sector, and they're trading at sort of 200 million revenue, but the way they run their business is extremely profitable. From that 200 million, they keep a large chunk of that 200 million, which gives them a massive buffer, gives them a massive margin. It means that even if a big cost comes along, they should probably still make profit every year. Whereas these guys are paper thin. They're thin on the ground in so much that a big expense can come along, which is, let's say it's 700 million. Well, that's nothing compared to the 16.8 billion that they're bringing in. So 700 million is a potential cost that could arrive at some point, and it would completely wipe out the profits. So they're too thin on the ground. As a result of that, I don't waste my time looking at the balance sheet, because the stuff is not good enough already. Already there are patterns and concerns here that mean that they wouldn't make it onto the clean watch list. Let's have a quick look at the chart and trading view. So essentially what we're looking at here is the time scale that we've just analysed in terms of what the share price has been doing over this time. And we've got a very simple exponential 200 period moving average on this chart, which is the orange line. And we're just looking at what has the share price done over that period. Now, you can see there have been opportunities to make some good money from a trading point of view. If you're trading a mechanical systematic approach, taking the long side on this company, there have been definitely opportunities to make some good money. But looking at it from a buy and hold approach, the share price isn't much different since 2009. It's gone up a little bit. It's gone up from about £4 a share to £5.30 a share. So it's gone up a little bit, but not by very much for a 10-year period, right? The growth is not very exciting over a 10-year period. And it kind of that reflects the numbers, right? I mean, the revenue's been dropping down. The business is rather stagnant. It's not really been doing much. It's not really been growing much. And as you can see, the share price has been reflective of that. It's really not done that much over this time. When we take a much bigger step back and we look at the fact that it's gone up from about £4 to £5 a share over 10 years, that's not very good growth. And in fact, we could look at this company and go back even further, and we could go back to the year 2000, when they were trading at £4 a share back then. £4 a share back in the year 2000. So we're looking at 19 years, and the company is still, it's been down as low as £1 since then, and it's been as high as about £5, but it's not good. It's not the sort of company that I'm interested in. Now, I'll be really clear. This doesn't necessarily mean you can't make money from BAE Systems. By a buy and hold trader that got in early 2003 would have got in at £1 a share and be sitting on £5 a share right now, and they'd be doing okay. It's still 16 years to wait for that, so it's still pretty slow, but it would be okay. And traders could still make money out of this company. People that are getting in and getting out over the course of, let's say, a year, of a longer term trading system, or buying when this price goes above the 200 and getting out when it crosses below the 200. There are clearly opportunities here to have made money on BAE Systems. The point of what I do and the work that I do shows me that there are better companies than BAE Systems for me to invest my money in. And it's a comparison process. I'm not saying BAE Systems are a bad company. I'm saying there are better companies out there than BAE Systems for me to invest in. And it's for that reason that I am not interested in investing in BAE Systems. They would not make it onto the clean watch list. Dividend-wise, they're paying 22.2 pence per share, which is a yield of 4.83. So dividend-wise, they're pretty good. They're not bad. And that might be a reason why some investors are interested in BAE Systems. But for me, I'm not geared towards dividend payments. It's not my strategy to make money. I obviously enjoy the dividend payments, but it's not my primary focus. I'm more interested in capital gains. But for me, just to kind of wrap things up here, BAE Systems don't make it for me. They're not good enough. There are much better options out there that I have identified, made as part of the clean watch list, that I am investing in, that I am trading, that I am even spread betting on 1 hour charts very, very well. And you can see other videos where I've been doing that, and I'll be showing you guys what I'm up to there. But BAE Systems don't make the grade, unfortunately. The numbers are not good enough. There's some questionable patterns there in terms of the revenue going in the wrong direction over the last 10 years. The share price has been very stagnant over those 10 years. These guys may well transform themselves and have the best 5-10 years going forward. However, previous data has not suggested that there's any reason why that might suddenly happen. And two, there are companies out there that have been showing fantastic results over the last 10 years that are on a run, that are growing, that I'm more interested in, that I'm putting my money into. and they're showing far better margins, they're showing far better results. So that's all I've got to say about BAE Systems PLC. Relatively good company, but a bit too thin on the ground. The numbers are not good enough. There's some concerns there around the drop in revenue. Interest on debt is very high, and the share price has been stagnant really for the last 20 years and not really doing much. And so therefore, I know there are better companies out there for me to invest my money in, and BAE Systems are not one of those companies that I'll be adding to the watch list. If you enjoyed this video and you want to see more of this kind of analysis on different companies, then please give the video a like, just to let me know that you're a fan, that you enjoyed it, that you got something out of it, and subscribe to the channel if you haven't done so already, because I'm going to be planning to do more of these if they are considered to be useful. And say hello, get in touch, drop a comment underneath, let me know what you think, and I will get back to you. I pretty much do on every single comment usually. And but yeah, thank you very much for watching. I hope it's added some value, and I'll see you guys soon. Cheers.